Dollar cost averaging is a term and investing strategy that is tossed around all the time. So in today's video, just for beginners, I want to go over, okay, what is dollar cost averaging and is it still viable in this overvalued market? Hey, my name is Tucker Krause and welcome to my channel. In today's video, I'm going to be going over what is dollar cost averaging and some of the common strategies it's used in, as well as its pros and cons and should we be using it in each of our portfolios, or what are the situations we should be using it in today. Dollar cost averaging is essentially increasing or decreasing the average price you've paid for a stock. Let's say theoretically you bought 10 shares of a company at $50. That means your average price is $50. Now let's say the stock price drops to $40, so you buy 10 more shares at $40. That means your average price went from $50 down to $45. This is really good because let's say the stock then goes up to $55. That means you're up $10 per share if your average price is $45, whereas if your average price was still $50, you'd only be up $5 per share. That previous example is a way you could actively use dollar cost averaging to improve your portfolio. But the most common strategy that is used with dollar cost averaging and is recommended by a ton of big finance channels and whatnot is to simply, okay, I'm going to invest this set amount of money at this set time into typically an ETF or an index fund. So that could theoretically be, okay, I'm going to invest no matter what the price is, just do it anyways because I want to take advantage of the stock market. Is, okay, I'm going to invest $100 at the end of every month into VOO, which is an ETF that tracks the S&P 500. But this is an example of how it could be used passively rather than actively. Now onto the pros and cons and sort of more so the dangers of especially passively dollar cost averaging, especially in today's market. Dollar cost averaging is great if you're using it to decrease your average price, like in the first example. You almost never want to be dollar cost averaging up. So when you see this company that you like and their share price falls and you're able to dollar cost average lower, you should go for it. Why not? As long as it's still within a good margin of safety price. But you shouldn't be passively investing into this overvalued market, which you can clearly see by looking at, say, the Shiller PE or the Warren Buffett indicator, whichever indicator you want to look at. That's because constantly you're going to be dollar cost averaging up, and chances are the price of, say, VOO, which tracks the S&P 500 again, is likely going to fall drastically in the future once this bubble bursts in this overvalued market, and so your average price is going to be substantially above that. Yes, it'll come back eventually, but you could have been making much better returns if you had been actively using dollar cost averaging. Not to mention, if you're charged, say, a larger fee on your transaction, let's say it's a $10 fee and you are only investing $100 a month, that is a substantial fee compared to how much you're investing. Whereas if you were lump sum investing into a good company with a 30-40% margin of safety, let's say, and you put in $1,000, that fee is not nearly as much compared to just slowly dollar cost averaging in. Dollar cost averaging is great if you're using it actively as another tool as an investor to help balance out your prices on the stocks you own. But if you're just passively doing it into the S&P 500 VOO, especially right now, it's not a great idea. But the one exception to that is if, say, you're putting into a 401k retirement account, because sure, over the next few years, it's very possible you'll lose money by dollar cost averaging in, and in that case, it's a lot better to hold cash or look at undervalued companies. But if it's just into, say, a retirement account into a 401k you don't want to worry about, then I think it's a great strategy because in the long run of decades, the market's always going to go up. Even if it's overvalued right now bursts, it'll go past that eventually, unless you're Japan.
Though to be fair, what Japan was doing in the 80s with modern monetary theory is kind of what we're doing right now, so it's actually entirely possible, but that's a discussion for another video.
Okay, if this video helped you, make sure to smash that like button, as well as if you have any other topics you'd like to learn about, let me know in the comment section down below. But in the meantime, you can go check out this video I made on what's the PE ratio, and so thanks for watching, I will see you next time.